$40 billion. That's the insured loss from the LA wildfires, January 2025. The largest wildfire insurance payout in human history. Swiss Re confirmed it. 16,000 structures destroyed. 29 deaths. But here's what they're not telling you. California's insurer of last resort has $458 billion in exposure and $377 million in cash. That's 0.08% coverage. When the money runs out, you pay, and I have the documents to prove it. January 7th of 2025. Santa Ana winds hit Los Angeles County. Hurricane force gusts. The Palisades fire ignites. Within hours, it's tearing through Pacific Palisades. Median home value, $2.5 million. The Eaton fire follows. Altadena, La Cañada, Flintridge. 23,000 acres for Palisades. 14,000 for Eaton. Both fires spreading faster than firefighters can contain them. This is not a natural disaster. This is an economic time bomb that insurance companies saw coming and ran from. 2023. State Farm, California's biggest insurer, stops writing new policies. 2024. They cancel 70% of renewals in Pacific Palisades, zip code 90272. Allstate follows. Farmers Insurance follows. By September 2024, 1,400 properties in that single zip code have only one option, the California Fair Plan. The insurer of last resort, exposure in Pacific Palisades alone, $4 billion. And State Farm knew. They all knew. The question is, what did they know that you don't? Swiss Re Institute, December 16th, 2025. Quote, LA wildfires, costliest ever wildfire event globally with insured losses of USD 40 billion. This is the reinsurance industry, the people who insure insurance companies, confirming what we already knew. This is not an estimate, this is the bill, and someone has to pay it. The question is who? Because the companies that should pay, they left before the fires even started. Here's the part that should terrify you. State Farm didn't leave because they couldn't assess risk. They left because they could. They calculated the probability of catastrophic wildfire in Pacific Palisades. They calculated the potential payout. And they decided, exit now. Avoid the loss. But homeowners couldn't exit. They're stuck with fair plan. Underfunded, overexposed, and backed by a system designed to push costs onto you. If this kind of financial investigation is new to you, you're in the right place. We expose these patterns every week. Subscribe. 2024. Fair plan policies in Pacific Palisades grow 85% in 1 year. 1,430 policies by September, each capped at $3 million coverage. But homes there average 5 to 10 million. The gap, uninsured. When fire hits, owners lose millions in value with no compensation. Stop. Before I show you the fair plan's actual financial position, understand this. What you're about to see is public record. They filed these numbers with California regulators. Nobody hid this. They just hoped you wouldn't look. California Fair Plan. Created in 1968 after Watts riots. Purpose: provide fire insurance when private companies won't. It's not a government agency. It's a pool of insurance companies required by state law to participate. When Fair Plan pays claims, private insurers reimburse it. When Fair Plan runs out of money, those insurers get assessed, forced to contribute. And when insurers pay assessments, they pass costs to policyholders. You, the homeowner in Ohio, Florida, Texas, everywhere. September 2024. Fair Plan's total statewide exposure, $458 billion. Cash reserves, $377 million. That's a coverage ratio of 0.08%. If you own property in a natural disaster zone, hurricane, tornado, flood, earthquake, wildfire, your insurance company is calculating the same exit strategy State Farm used. Your rates already climbing? That's them pricing in their escape. You're one catastrophic event away from the same situation. Quick question. Has your homeowner insurance rate increased more than 20% in the past 2 years? Type yes or no below. Follow the money. Homeowner pays premium to Fair Plan. Fair Plan pays claims. When claims exceed reserves, Fair Plan assesses private insurers. Private insurers pass costs to all their policyholders, even those not in fire zones. Your Florida hurricane insurance goes up when California burns. Your Texas homeowner policy subsidizes Pacific Palisades. This is the system. And insurance executives said it was financially sound. Send this to anyone who thought insurance markets were fair. They need to see the actual structure. Fair Plan has reinsurance, insurance for insurance companies. First $900 million in claims, Fair Plan pays from reserves, $377 million cash, plus $523 million from insurers. After that, reinsurance kicks in, $350 million available. Then more layers up to $5.78 billion total. But here's the structure. Fair Plan must pay approximately $3.5 billion, including a $900 million deductible and co-pays, before accessing all reinsurance. That's 9 times their cash reserves. How do they cover the gap? Assessment, meaning you. July 2024. California Insurance Commissioner Ricardo Lara cuts a deal with insurance companies. New policy. If Fair Plan losses exceed $2 billion, costs split 50-50. Half assessed to insurers, half assessed directly to policyholders. Consumer Watchdog estimated the fire tax at $1,000 to $3,700 per household. Wait, I know what you're thinking. That's only if Fair Plan hits $2 billion. Let me show you why that's exactly what they want you to believe. Because Fair Plan's exposure in just Pacific Palisades and Eaton fires combined, $4.8 billion. They'll hit $2 billion in these fires alone. California Fair Plan. Official update, January 29, 2025. Pacific Palisades fire exposure over $4 billion. Eaton fire exposure over $775 million. Total $4.8 billion. As of February 9th, they've already paid $914 million to policyholders. That means they've hit the $900 million deductible for reinsurance. They've triggered the assessment mechanism. Remember Swiss Re's $40 billion total? That's insured losses across all insurers. Fair Plan alone is underwater. This is why I investigate these systems. Subscribe if you want to see what else they're hiding. But we're not done, because behind every number is a person. 4,800 claims filed to Fair Plan so far. 45% total losses. Homes completely destroyed. 45% partial losses. Structure damaged but repairable. 10% fair rental value only. Rental income lost during repairs. Each one represents a family, a business, a life savings wiped out, and most will get far less than they need to rebuild. Because Fair Plan coverage caps at 3 million residential, 20 million commercial. In Pacific Palisades, that doesn't buy a foundation. Robert Rivani bought a Malibu beachfront home on Billionaires Beach for $19.55 million in 2022. Spent $27 million buying and renovating. Planned to list it for $40 million in spring 2025. Palisades fire destroyed it. Total loss. Wall Street Journal reported his story. Even with maximum Fair Plan coverage, $3 million, he loses $37 million. But most owners aren't billionaires. Most had 30-year mortgages. Life savings in home equity. Fair Plan caps mean they can't rebuild in the same neighborhood. They're financially displaced. Altadena, unincorporated community. 42,000 residents. Working families. Teachers. Firefighters. Not billionaires. Eaton fire destroyed 7,000 structures there. Many had basic Fair Plan coverage, not enough for reconstruction costs in 2025. But the insurance documents don't show the displacement. The multi-generational homes lost, the family businesses that won't reopen. They don't teach this in business school. How markets engineered to privatize profit and socialize loss actually function. Now you know what insurance executives have known for years. Have you or someone you know lost a home to wildfire, flood, or hurricane and faced insurance shortfalls? Share your story below. And here's the part about you, because I saved the most disturbing evidence for last. This isn't just California's crisis. Florida's Citizens Property Insurance, that state's insurer of last resort, already collapsed after Hurricane Ian. Homeowners paid a hurricane tax of hundreds of dollars per household to cover the shortfall. Texas Fair Plan is growing. Louisiana's is growing. Every high-risk state is watching California's FAIR Plan fail in real time. And your insurance company is calculating when to exit your market next. Pacific Palisades, January 2025. Insurance companies exit before catastrophe. Florida Gulf Coast, 2022. Insurance companies exit before Hurricane Ian. New Orleans, 2005. Insurance companies exit before Hurricane Katrina. The pattern repeats: high-risk zone, rising premiums, market exodus, insurer of last resort overwhelmed, homeowners trapped, taxpayer bailout. Check your homeowner insurance policy. If your rate increased more than 10% last year, your insurer is pricing in their exit. If your coverage decreased, they're limiting exposure. Send this to someone in a coastal or wildfire zone. They need to see the pattern before their market collapses. AccuWeather Economic Analysis, January 16, 2025. Total damage and economic loss from LA wildfires, $250 billion to $275 billion. Remember Swiss Re's $40 billion insured losses? That's 20% of total economic impact. The other $230 billion? Uninsured losses, lost wages, business closures, infrastructure damage, health costs from smoke exposure, relocation costs, the gap between insured and actual loss. You will live through more of these events. The question is whether you understand the financial reality before your market collapses. This is happening now. Subscribe to understand the pattern before the next disaster begins. Here's what the data shows. Insurance markets function efficiently when risk can be calculated, and premiums cover expected losses. But climate change is breaking that model. Wildfire risk in California is no longer insurable, at premiums homeowners can afford, so insurers exit. Fair plans absorb risk. Fair plans fail. Costs shift to taxpayers. The cycle repeats. Here's my controversial take. This isn't market failure, it's market success. Insurance companies correctly assessed that California wildfire risk exceeds profitable premiums. The system is working as designed for them. Tell me I'm wrong in the comments. You can't unknow this. Every insurance rate increase, you'll recognize the exit strategy. What will you do with this knowledge? What topics should I investigate next? Most interesting suggestion gets the next deep dive. Next investigation, the offshore wind farm that went bankrupt owing contractors $900 million. Vineyard wind, blade failure, federal investigation, and the insurance loophole that let developers walk away or vote in comments. Florida's citizens' property insurance collapse. Texas power grid financial failure. The corporate bankruptcy case you choose. If these financial investigations matter to you, subscribe and hit the bell. I expose what mainstream media won't touch. We follow the money every week. Click here for the Baltimore Bridge collapse. $102 million settlement, but $4 billion in total liability. Or this one if you missed it. See you there.